4 p.m. here at DBS Asia Central. We're here live, presenting you yet another month of Macro Insights live stream from DBS Group Research. I'm Taimur Baig, Chief Economist. I have here with me Philip Bui, Senior Strategist for FX. Hi, Philip.
Hi, Taimur. Good to be here.
It's been quite a couple of months on the FX front, so we will devote quite a bit of our discussion discussing what's happening with the FX area.
I'm sure everyone will be very excited to know where it's going.
Yeah. I think you have lots to look forward to as far as Philip's presentation and the various returns we expect and have been seeing and monitoring on the FX front, but starting with the U.S. monetary policy and its impact on the DXY. So normally I spend a lot of time talking about those things. I'll not do it today. I will leave it all to Philip. So he will discuss our house views on rates and FX and how the intersection between those and the U.S. monetary policy come in. I will take a bit of a different tack, although the title of today's presentation is Pitfalls of an Everything Rally. That is actually the second part of my presentation. I will actually begin with talking about a trip that I took last week through China and share with you some of the takeaways from the China trip. So Philip, while I do this, I will excuse you, and you can come back when I'm done with these two areas, and then you can help us with the FX part.
Okay.
Thanks very much. Very well. And as always, as the practice is, that we will be happy to receive your questions. Here's the QR code for that on the screen. On Pigeonhole, click on that or scan that and submit your questions. If you cannot do that, just go to dbs.pigeonhole.at with the password macrojune24. If I've said those things very fast, don't worry, we will come back with that information again. But here, right now, is the outline of our presentation. Straightforward. I will do two things, China trip takeaways, as well as the whole thesis behind the everything rally and the pitfalls around it. And after that, Phillips will come and do a fairly extensive FX roundup. After that, we'll be happy to take your questions. So the China trip was an eye-opener for me. It was my first trip there since the pandemic, and when you read newspapers and analyst reports, you think that you have a pretty good handle on the macro. China is going through a huge property crisis. The authorities are facing all sorts of headwinds as far as geopolitics is concerned. They face aging, they face trade restrictions, market access issues. All those things, you don't need to go to China to find out. What helps when you go to China is the conversations you have with colleagues and counterparts and clients, the newspapers you see that the local Chinese read, or the things that are being discussed in the media, in the Chinese media space, which I think gives one a very differentiated view from the somewhat Western-centric media analyst perspective that we get sitting here, whether in Singapore or in the US or elsewhere in the world. So what I'm going to do now is share with you 8 takeaways from the trip. And in fact, at the end of 8 takeaways, if I'm within my time schedule, I'll share with you a couple of things that are not on the screen as well. So the first takeaway, there is absolutely no mincing the word. The Chinese economy is inflicted by what we call weak aggregate demand. The economic momentum is by no means alarmingly slow. We are still forecasting 5% GDP growth forecast. In fact, the week we were in China, the International Monetary Fund also upgraded its GDP forecast for 2024 to 5%, joining the analyst community, if you will, like us and others who have been forecasting 5% growth for a while. We run now casting on China, and whatever data we have for the months of April and May also suggests to us that the overall growth trajectory of 5% for the year 2024 is eminently achievable. So the fact that there is weak aggregate demand in China, the fact that we still have lots of concerns about consumer sentiment, about investment sentiment, all of that is given. And I think it's also fair to say that the weak aggregate demand is primarily, not only, but primarily a function of the big property market consolidation that is taking place in China. This was at sometimes 20 to 30% of GDP. The upward movement of property prices added substantial wealth and had a transformational impact on the way the Chinese saw the world from the lens of their own prosperity. All of that has come to a halt over the last 3-4 years. Authorities are struggling. In the subsequent bullets, I will talk about some of the measures that the authorities are taking. But the bottom line, or the starting point with China, is that while we like many things we see in China, we're concerned about some things in China, but the starting point is the aggregate demand is weak. Now, there are other things, that are happening in China, and then we need some degree of policy impetus behind it. You cannot just think about a property market resolution would immediately turn consumption around, because there is a reason why people in China don't consume a lot. They have insecurity about retirement. They have insecurity about education cost, things that make people want to hold back savings. So there are major needs for a wide range of structural reforms on social welfare, pension, healthcare, education, and only then the country will sort of move toward consumption-led growth, and that is not going to happen anytime soon. And again, there is no mincing those words. We may have some optimism about China in the near term around certain policy-driven dynamic, and I'll talk about that later also. But by and large, the balanced growth, the reduction in over-reliance on exports or heavy construction, that is an ongoing process in China. That's not going to turn around and lead to balanced, sustainable growth anytime soon. So the 2024 forecast upgrade by the IMF and the rest of the street needs to be seen in that context. The overall demand dynamic is on the weak side, even if the 2024 story is a decent one. And there's good reasons for that beyond the property market issue. The Chinese individuals and customers and business owners also see the news. They also face issues related to technology access, market access in the West. They worry about their jobs if they're working in an export-oriented company, especially when they hear about capital not coming into China, new capital from outside investors, and they also read about Chinese companies moving outside of China, and therefore those companies may continue producing, but they will be hiring non-Chinese workers outside. These things do get people worried, and that, I'm sure, acts as a dampener as well with respect to consumption sentiment. And one thing that I really realized, and you don't really read about it in the media, it's been a couple of years, but the scarring from the COVID pandemic is still clear and present in the minds of people. They really suffered in those years. The lockdown was tremendously dispiriting, and there's a lot of anger and frustration about that. And people saw permanent loss of income that they're still struggling to sort of make up for it. But I think it was more likely a permanent as opposed to a temporary loss. So that loss will not be made up, and that would certainly affect people's psychology. The third thing, again, you can read about this, but you only appreciate it when you travel through cities like Shenzhen and Shanghai and Beijing, that you start appreciating the regional variation. You go to a place like Hangzhou, where the authorities have more or less abolished the hukou system. If you want to buy a property there these days, all you need is like 6 months of tax return. You don't have to be a formal resident anymore, and that would fundamentally change the attitude towards a home purchase over there. If you are in Shanghai, putting aside the property sector, if you want to buy an EV, you don't have to bid for the number plate, which people with internal combustion engine cars have to. And as a result, again, tremendous incentive to go consume EVs. You don't see that many EVs on the streets of Beijing because the government of Beijing has decided not to follow the same policy as the government of Shanghai. So whether it is in property or in EV, substantial regional variation in policy, and within sectors also. I think that actually goes without saying. There's tremendous heterogeneity in China right now. If you happen to be in the EV space, cutting-edge technology, exciting, people want to buy your cars, but also intense competition across China. You see brand after brand of made-in-China models, and these are not caricatures of Western brands anymore. They look genuinely new, fresh designs with a lot of additional value added that you don't see in their competitors in the West. And from Beijing Auto to Shanghai Auto to BYD to collaborations between Geely and Baidu, Xiaopeng, all sorts of made-in-China brands that I did not even know about 4 or 5 years ago. They're ubiquitous. They're good to look at. They have tremendous performance. But again, that's one sector. If you go to steel, going through a lot of green transition-related consolidation and changes in technology, earnings are definitely going to be under pressure there. If you go to pharma, still energized by FDI, one of the rare areas in the Chinese business landscape where there's still a lot of FDI. But then again, if you go to construction, surprise, surprise, things are not good. So I think one needs to appreciate this wide range of regional variations and sectoral variations in China. And by the way, it is related, on a related matter, there's also significant heterogeneity with respect to local government policy. Some governments are taking the property sector head on, some are a little slow, some are really championing green transition, others are not. Now, we met with lots of companies who are in the lending business, banking, non-bank financial companies, leasing companies, and they were talking about how difficult their life has become because while the rest of the world rates are going up, in China rates are coming down, liquidity is ample, banks or non-banks are both competing for the same group of customers in personal loan and auto loan space, and as a result, they're all driving down interest rates, their own margins. So a lot of doom and gloom about those who are in the lending business, how they're not making a lot of money. But there is a counterpart to that. That's the Chinese consumer. It has never been this cheap to borrow money to buy a car, to finance some consumption beyond cars, as well as to get a mortgage. So while on one hand, overall demand environment is a bit subdued, there is no question there's a lot of overhang from the property sector. All those are true, but it is also true that by steadily cutting interest rates and steadily injecting liquidity, the Chinese authorities are making the macro environment far more amenable toward debt restructuring, loan refinancing, or outright new purchases to fuel the consumption of goods and services by the Chinese. The issue related to green transition, I've already touched upon it in my third bullet when I was talking about the EV sector being a dynamic one. But you really need to go to China to really feel it. And by what I mean by feeling it is, A, one is dazzled by the variety of cars. B, one sees blue skies in cities that one didn't in the past. I went from Shenzhen to Shanghai to Beijing. Maybe I was lucky, but I got bright blue skies everywhere. And I'm sure there is something to do with green transition. And it's not just a feeling. When you look at published journals on particulate time series in cities across China, China is by no means at the Scandinavia level in terms of clean air, but it is substantially better than it was 5, 10, 15 years ago. And it is a testament to China's green transition in embracing renewables, in embracing electric automaking. And as a result, we're seeing this dividend, if you will, in terms of particulate pollution. It doesn't end there. The biggest dividend, in my view, other than the blue sky and the cleaner air, is the sound pollution. Any large city in the world you go to, you hear a drone, the humming sound, constant humming sound of internal combustion engines running through the city day in and day out. You'll hear that in Singapore in the morning, in the middle of the day. You'll hear that in New York. Of course, you'll hear that in cities like Mumbai and Jakarta. In large cities in China, particularly Shenzhen and Shanghai, where huge amount of EVs are roaming the street, that sound is almost gone. When an ICE car comes in with an internal combustion engine, it is jarring to hear that sound because all the other cars, motorcycles, transportation vehicles are all moving around the city, a high density, highly populous city with making no sound at all. As a result, the collective sound level of the city has gone down substantially. You have to be in that city to feel that, and that's why I mean that stepping into China is to see green transition in action. Of course, before landing in any airport, if you're over waterways, you will see endless wind turbines. You don't have to travel far in China to see endless area of solar cells. So substantial investment taking place. The China Trip Notes that we published on Monday gives you some numbers on the kinds of transformational investment that is happening in China on green transition. But again, if somebody wants to get excited about this sector, they need to travel to China to see it. Now, again, I'm going to try to balance, my enthusiasm from my trip to actual ground reality. Of course, we met a lot of manufacturers and companies who are very concerned about the outlook. They see the global trade environment becoming particularly hostile toward China, lots of tariff coming up, perhaps in the EV space, even in Europe, following what just the US pushed through. I think that the Chinese companies, aided by the government of China, are trying to be as pragmatic and as intrepid as possible. So let's unpack that bullet number 6 that I have on the screen right now. They don't expect things to get better. They think tariffs are going to go up more. They think non-tariff barriers are going to go up more. That's a given. So now how do you pursue your dream of expanding your industrial prowess in the world, given that there will be significant additional restrictions on exports? So I heard a lot about the two-pronged strategy. This is typified or exemplified through the EV supply chain, but I think it applies to a wide range of manufacturing products as well. Twofold. Start with the low-end manufacturing. You can buy EVs in China for $10,000 today. Even 100% tariff on that car will leave that car competitive in European and US markets, because there are no particularly competitive $20,000 EVs in the West either. So at the very low end, the incredible economies of scale that the BYDs of the world enjoy will allow them to remain somewhat competitive even after the huge tariff that is almost certain to come. Beyond that, of course, once you get into the mid and the high end, where the brands have to differentiate themselves, where the cost of production is much higher, it is not that easy to be profitable with 50, 60, 100% tariff. There, Chinese manufacturers, EV and beyond, are pursuing the strategy of embedding themselves in free trade zones. You pick Mexico to be embedded into USMCA, or Canada as well. You pick Poland or Hungary to be part of the European Union trade zone. You pick Vietnam to be part of RCEP, or you even consider Indonesia as a place to do business. And again, if you have some value added from China, but most of the value added coming out of those countries, it will go to the US through the trade agreement's tariff-free aspect, and as a result, some of those China-specific tariffs would be circumvented. So that's the kind of strategy we're seeing, the two-pronged strategy. At the low end, having the confidence to be competitive even with tariff. At the mid and high end, actually go closer to the place, join the friend-shoring zeitgeist, if you will. Now, of course, given how adversarial the world is becoming, maybe even that is not going to be sufficient. Maybe under the guise of data security or the guise of third market competitiveness, the Americans, Europeans will find even those products made in their own free trade zone not acceptable. But that is, I think, a good few years away from us. I'm talking about the strategies that is being pursued now under the current laws of trade and tariff. I think these two strategies make all the sense in the world. The property sector. Can't really avoid it. Let's come back to that. Talked about in the context of consumption, but now let's talk about in the context of economic stabilization. China badly needs the property sector to consolidate. And that consolidation will be painful, no doubt about it. Companies will become smaller. Huge value will be lost. Write-downs, bankruptcies, liquidations will happen. The authorities simply will not pursue free-for-all, open-ended support policy, which creates zombie companies that ought to be out of business but remain in business for years and decades to come. They have seen Japan. They don't want that to happen to their country. So what are they doing? If you look at the totality of measures in the property sector over the last 4 or 5 months, it is truly impressive. Down payment requirements have gone from 25% to 15%. The floor on interest rate for mortgages have been removed. Households can buy 3 apartments in big cities as opposed to 2. As I said earlier, there are cities that have relaxed residency requirements substantially for housing purchases. And then there's a Chinese form of QE. You may remember during the global financial crisis, the US Fed started buying mortgage-backed securities to backstop the property market. Well, the Chinese are not going that far, but the PBOC is underwriting hundreds of billions of dollars of loans for provincial governments to go buy unsold properties in their localities. And that is hopefully an area that will start churning and producing results in the coming months and quarters. So from central bank support to provincial competition as to who can support the property market more, to removing housing residency requirement to purchase properties, things are really happening. You can look at every single measure on their own and say this is not sufficient given how big the problem is, but when you add them all up, they look consequential. I think that these elements would be sufficient to start putting some sort of a bottom in China with respect to sentiment. Prices may have to adjust further. Restructuring might entail more pain, but with respect to sentiment, that is the critical thing of all. We might have already seen a bottom given all those measures. And as far as our China macroeconomics team is concerned, expectations are even more easing measures are coming in the second half of this year. All right, final point on China, which seems to be bit of a repeat of what we had earlier, but let me just say that there is a difference. In point 2, it was about consumption being supported, but now we're talking just in terms of making the economy a little more balanced. And there again, we need structural reforms in China, not just cyclical support for the economy, and that's why we brought this issue back up. Then the final takeaway from China is that the authorities cannot get completely blindsided and overwhelmed by the property sector and the trade war, tech war. The country also has secular headwinds. It's becoming more expensive to manufacture. It has an aging population. It has major climate-related imperatives and urgencies. Those things have to make progress independent of counter-cyclical measures to stabilize consumption and the property market, and that's what's needed. I'm going to end my China section by sharing with you 2 photos that I took during my trip. This is last Saturday in Beijing. We were walking past the Forbidden City, and as you can see, it doesn't get any clearer than this in any city in the world. How beautiful is the water and how sharp the reflection is from top to bottom from the parapets of Forbidden City. Second one was taken actually from my hotel window, which actually did not have the clearest of glasses, but you can see the sunset over Western Mountains. Again, reading about these things is one thing, but being there, seeing these things in lifelike features is really allows you want to really appreciate the gains from green transition. All right, back to the bread and butter sort of discussion. Everything rally. Now, the last week or so, we have seen some weakness in global markets. But let's talk about what's happening through the course of this year. It's not just about the last few days, but what an extraordinary strong financial market set of returns we have seen through the course of this year. This was the year 3, if you will, of monetary policy tightening. It began in 2022. We thought 23 was the year when the system was going to break under the burden of high interest rates. Did not happen. We thought this was the year when recession was certainly going to materialize, and the first half of the year we'll probably see even rate cuts. All of that seems so far away behind us, but let's not forget, even as recently as January, the market was convinced there'll be substantial rate cuts in the first half of 2024. And of course, now the view is that the Fed will struggle to even cut in the second half. During the course of all this back and forth between the fixed income markets pricing of how much the Fed may hike and its attendant impact on a wide range of assets, including FX, we have seen some extraordinary developments in the area of commodities. Oil, despite the problems in the Middle East, exacerbation of the situation in Ukraine, nothing. If you look at this chart on the screen right now, this is price relative to 2010, and oil is basically flat over the last 15 years as far as year-on-year change is concerned. So $70, $80, $90 oil, we have been there so many times. I really don't think even a 5-10% upside to that spoils market sentiments, create inflationary fears at all in this world. But once you go away from oil, look at the very interesting developments that's happening on copper and gold. China, as I said just now, aggregate demand is soft. It's facing lots of headwinds. And it is the marginal buyer of copper in the world, given that it is the manufacturing powerhouse of the world. Copper should not be rallying, but copper has rallied mightily this year. As you can see, a few months ago, it was up about 50% relative to the 2010 level. You would think that this might be a reflection of the whole AI tech boom that's taking place, that you need much more copper to build data centers and other infrastructure for the high-tech industry, perhaps. But again, those things normally get conduited through China. We haven't really seen that. Whatever the case, copper seems to be rallying and reflecting quite a bit of confidence about the electronic sector going forward, notwithstanding all these trade war and trade restrictions in there. Second striking development is on the precious metal side. Gold's rally has been nothing short of spectacular, and I would say, or I would assert, ahistorical. Historically, the relationship between gold and safe asset yield is inverse. If safe asset yields are high, precious metals like gold, which yield 0, prices fall. This time, we have short-term interest rates at 5.5%, and gold hitting $2,400, $2,500 in the ongoing months. What gives? I really don't think we should even try to explain the gold rally in terms of fundamentals. It is a reflection about unease on geopolitics. We have seen weaponization of the US dollar in the last few years around various conflict. We have seen questions about US doing a broader range of sanctions against countries that they don't like, which has made countries, individuals, companies a bit more concerned about holding the US dollar. Not everybody is extreme close allies to the US, and they worry US through its political cycle could start picking and choosing friends and using the dollar as a weapon. So if you worry about the dollar, what do? You basically buy gold. You're not going to buy Chinese government bonds because you don't know where the Chinese RMB is going. You're not going to buy European bonds because you worry about Europe's debt sustainability just from the massive mountain of debt that they've issued. So if you are really not that keen on holding US dollar assets, what do? Surely not Bitcoin. I think it makes much more sense to hold gold, and that's what we're seeing. And when we see third-party data collectors who analyze gold holding and gold purchases, what we see is whether it's the Middle East or Latin America, even Africa, and then also Asia, there's a lot of government level, sovereign wealth fund level, provincial government level, and individual level gold purchases taking place. That's what's driving gold. Talk about rally. Even more spectacular is the stock market rally. I'm showing only the US data and US analysis, but you can extend this to Nikkei, to India Sensex. Even Chinese stocks in the last 4 months have actually returned a decent amount, high single digits. So what's happening in the world? Record after record in S&P 500, precisely at a time when volatility keeps falling. Doesn't, to me at least, quite make sense. We have geopolitical worries. We have economic fragmentation worries. We have no idea what climate change will do to global production of food, electricity, et cetera. Equity markets have seen all those doom and gloom reports and ignored them entirely. It keeps hitting records. You could argue it's a narrow rally. It's driven by the hype around AI. All that is true, but when we look at performance of American companies beyond tech, they're also pretty impressive. Their earnings have been good. So it seems to me that this sort of rally is also taking into account the massive fiscal stimulus that is supporting investment consumption in the US, which in turn is feeding strong earnings, which in turn is justifying these extremely high market valuations. I do worry that the system could break, that there could be leverage in the system, there could be unseen risks by us in the system, which could manifest in a destabilizing manner, because these sort of relentless rally, it makes me nervous. When we look at the yield gap, the gap between 10-year US Treasuries and the S&P 500 dividend yield, it's over 3%. You have to be exceptionally bullish and optimistic about the growth potential of the companies you hold to remain long equities when the yield gap is at that historic high. And as you can see, when you have yield gap over 3%, I guess the case in point would be 2007, 2008. That, of course, ends in a great deal of tears. Let's all cross our fingers and hope that we're not going to do that. But certainly, attractiveness of holding equity, unless you believe in a fundamental change in paradigm driven by AI, is questionable and worrisome. I do worry about the sustainability of the equity markets in the US, and by extension, what that contagion, if there's a big sell-off, could mean for the rest of the world's equity markets. Now, you may think that the equity market is sanguine, but if you really want to see sanguine, you come to the credit markets. US spreads and the high yield space and the investment grade space are in multi-decade lows. They have come down sharply, and we have not seen this sort of comfort associated with the credit space in a long time. Why is this the case? Well, firstly, if yield is very high, even with narrow spreads, people are getting pretty decent nominal returns. So as you can see here, I'm showing investment grade spreads at about 1% over US Treasuries. Well, that means you can still get like 6%, 6.5% from investment grade bonds, and perhaps even 7-8% from high yield bonds. So nominal returns are really impressive, way higher than anything that we have seen in recent memory. And maybe that's why the spreads being narrow doesn't really bother anybody. They're still getting very nice absolute returns. And the second point is that liquidity is still ample. If you take the G4 central bank balance sheets today, despite all the quantitative tightening that the US has done over the past couple of years, it is still bigger than it was before the pandemic. So the central bank support through asset purchases that were built up in the pandemic period, it's still very much there. maybe that is another reason why risk perception around credit is rather benign. And it's not just the developed markets. You can see here credit spreads coming out of the emerging markets. I think this is a blend of both corporate credit and sovereign debt. But fact of the matter is, again, it's been a long time since we saw such comfort the market has with respect to credit. I would think under normal circumstances, as interest rates go up, you're going to have some problems on the credit space, and credit risk will go up. We're seeing almost the opposite right now. Now, on the currency side, Philip is going to come very soon, and he'll, of course, give you a very detailed rundown, currency by currency, where things are. I just want to point out how the market was caught wrong-footed, being short dollar toward the end of 2023 and early 2024. The market has capitulated entirely about that. As you can see, the net USD position is overwhelmingly long, the longest we have seen in this entire post-pandemic era. And the DXY, which is not soaring, but it's still not going in the way the many emerging market economies would have hoped in 2024. So the strong DXY long position on the dollar remains a reality with respect to the market. Against that, you would think that the EM currencies are selling off. There'll be a lot of volatility. But again, the conundrum, currency vols at the G7 space as well as the EM space are again at some of the lowest that we have seen in this entire 5 years since the pandemic broke out. So even in currency where we're seeing relentless strength of the US dollar, vols have collapsed. So credit space, spreads have collapsed. In currency, vols have collapsed. In equities, valuations are sky high. Go figure. So finally, on the fixed income side, before I give the mantle back to Philip, curves have shifted up this year, but not in an alarming manner. And we do think that if the Fed is going to start considering cutting rates at some point in the second half of this year or early next year, there is room for the long end of the curve to rally. What you have on the chart right now is US and Singapore's yield curve, both at end of 2023 and presently. The long end has rallied, has jumped up quite a bit during the period since then, end December to now. If there is some more data with respect to labor market weakness, with respect to disinflation, with respect to overall global economic momentum slowing down, expect the long end of this interest rates, both in Singapore as well as in the US and elsewhere, to rally. All right, I'm going to stop right now before Philip comes over here. Philip, come over. Let's remind you that we are happy to take your questions. Scan the QR code or go to dbs.pigeonhole.at. Passcode macro June 24, and I will keep an eye on the questions. And I'll come back once Philip is done, and we'll take some of your questions. Philip, all yours.
Thanks, Timer.
Thank you.
I always like to go after Timer because he gives a big rundown on all the major issues. So that makes my job easier. Okay, before I begin, I thought I'd share a fun fact. Today is the 5th of June. It's the birthday of John Maynard Keynes. So he's the father of modern macroeconomics. So if he's alive today, he'll be 141 years old, and he'll probably look at the world and say that nothing pretty much has changed since he was alive. Okay. Okay. So I'm going to give you a rundown on the FX. I'm going to start off with the US dollar. I think many of you are familiar with this chart that I've shown many times to many clients. This is just to, I think it's always good to review how the dollar index has been moving since the Fed hike cycle started. A couple of takeaways, and one is that dollar is very strong when the Fed sounds hawkish, and it drops like a rock when the Fed turns dovish. So we've just seen this big push back on the aggressive rate cuts at the end of 2023. And so the dollar has been moving up for 4 months. And we have just had a nice correction down in May. And I think that we might be continuing for the rest of the year. We have not changed our view for the Fed to cut rates, except that we are now no longer looking at 100 basis, but 50 basis, 1 per quarter into, I think, next year. Next week, we have the FOMC. I'm sure the Fed is going to remind everyone that the next move will not be a hike. And he'll probably emphasize that it's looking for inflation to come down month on month. And it's probably more optimistic about inflation, maybe starting to move lower in the second half of the year again. Okay, so but the more important thing I think for me is that with regards to the first 4 months of this year, 3 things have changed. Okay, one thing is that the U.S. economy is no longer that significantly exceptional. Okay, so just to compare, from the second half of last year, we had 3 to 5% growth. Last week, the U.S. just revised down first quarter growth to 1.3% annualized quarter on quarter from 1.6%. Meanwhile, EU and UK, they have exited their technical recessions this quarter. China's outlook has also started stabilizing. Timer just shared that the IMF has upgraded China's growth to 5%. We have done that earlier. And also recognizing that the measures, despite all the skepticism, is coming in to support the economy and the property sector this year. I think the second important one is the monetary policy divergence. Okay, we have been very caught up about the Fed delaying, and pushing for fewer rate cuts this year. But at the same time, other global central banks are also doing the same. For example, Australia has pushed out their rate cuts into next year, along with their forecasts for inflation to return to target. RBNZ is later in the year, and next couple days, ECB and Bank of Canada are going to cut rates, but they're not going to tell you that it's going to be a steady series of cuts. Okay, but more importantly, I think this year we've seen a lot of stress on currencies from the strong dollar. So this has led to, as Timer mentioned, people seeking safety, finding gold and precious metal more valuable, and are very unhappy, with the dollar strength. And in around mid-April, Washington, Tokyo, and Seoul, they surprised with a joint statement, so that agreed to consult closely on exchange rate. IMF also came out around the same time to say that it's okay, for interventions to address excessive volatility and disorderly markets. And indeed, we have seen that in Japan, Korea, Malaysia, Thailand, Indonesia, and Philippines in April and May. Okay, so as we come in, today is exactly 5 months before the US presidential elections, and markets are beginning to feel that after last month's retreat in the dollar index, that maybe they should start thinking about what might happen in the election. So these are the few points that sort of came up. One is that Trump's advisors have been, I think, plotting, the dollar devaluation. Then Trump has been pretty clear, that if he wins the presidency, he's not going to reappoint Powell as Fed chair. So this could raise some issues about independence at the Fed. But the other thing that's coming in is of course, fiscal sustainability. So next week, I think Powell is going to reiterate again at the FOMC meeting that the federal debt and the deficits, the current trajectory is unsustainable. Okay, if you look at, let's say, how the DXY has performed in the past US elections, so I've sort of compared, its performance, the one in black for this year, against those presidential years in the past, since the end of Bretton Woods. And these are the sort of closest that I have come up with. If we repeat 2020 and 2004, you're going to see, that the dollar could have a long way down. So that is if we are correct about, the U.S. economy losing its exceptionalism, maybe more concerned about the health of the consumers, and the Fed, becoming more open to rate cuts. Okay, tomorrow the ECB is going to meet. I've decided to call it a hawkish cut, although that's not very accurate. But we all know that the ECB has pre-committed to a June rate cut. And they'll probably emphasize that, they're not easing monetary policy. They're still, vigilant about inflation risk. It's just that interest rates are very high, so they're just removing top-level restriction. And therefore, they will still see the need for policy to be restrictive all years, And I think the other message, which we are more or less getting used to is that after June, the rate cuts that we'll be seeing for the rest of the year, they're going to be bumpy, and gradual. So they're going to be very dependent on data, and they may be making decisions meeting by meeting. So I gather the Bank of Canada will probably say the same if he does cut, his rates also this week before the Fed. Okay, so but as far as the euro is concerned, apart from interest rates, I've always been mindful about the economic backdrop, and I've noted that euro has been very resilient, defying all the calls, to drop below parity when the ECB rate cut bets were high, because the EU sentiment indices, and the ZOO, they have been coming up from the lows, and indeed, underpinning the euro. And I've mentioned earlier that the EU economy has exited its technical recession, and we'll probably see the ECB adopting a more cautious, optimistic stance about the economic outlook tomorrow. Okay, now Swiss franc at this point is very dear to me because we were quite happy when dollar Swiss finally rose, from the lows in the first 4 months of this year, when SNB started signaling that it didn't need to intervene in the Swiss anymore, and that inflation has come very nicely into its 0 to 2% target range for it to be the first global bank to cut rates before the Fed in March. Okay, so this slide was done last week. I decided to keep the first headline that we were looking for it to break below the recent range of 90 to 92 cents. We're currently below that. So, okay, we've made that call when we saw that the SNB reversed its stance. It's now concerned that inflation has picked up, as you can see in the chart, from 1%, and is now close to the SNB policy rate. So it blamed the recent pickup in inflation and the threat to its forecast, on the Swiss weakness. Okay, the other important point is that it also highlighted that the R star could be higher than the present estimate of 0%. So if you look at Switzerland's CPI on a harmonized basis, 1.5% is the same as the policy rate. So therefore, we don't think that SNB, would deliver a back-to-back cut this month. Okay. When it comes to interest rate differentials, nothing beats the yen. Okay, the yen has been subject to a lot of volatility, a lot of stress, because of the huge divergence between the level of interest rates. But then again, we are also mindful that the dollar yen until this year has been tracking, the 10-year bond yield differential. So Japan has ended NIRP, negative interest rate policy, in March. That turned out to be a disappointment for all the yen bulls. Dollar yen continued to hit to 160. And that's when, we had a trilateral joint statement that allowed the interventions to pull dollar yen back down from those levels. So, but when I look at, let's say, what lies ahead, the differentials, based on these charts, tells me that dollar yen, if the Fed cuts do come in and hurt the dollar, and if focus returns to the BOJ looking to hike again, on top of discussions later this month of reducing their balance sheet, then dollar yen could close the gap with the differential, and that will put dollar yen lower in a 140 to 150 range. Okay, so for the renminbi, so like China, the the market tends to be always skeptical, tends to be more pessimistic, but I like to step back and I like to look at the fixings, which I think has been quite instrumental in capping the spot rate about 2% above the fixing. Okay, so, and despite all the skepticism and about China's disappointing growth and its troubled property sector, like it or not, China has finally decided also to prioritize measures to support these sectors. And of course, the IMF has finally given in and upgraded this year's forecast to 5% from 4.6%. However, IMF is still looking for China's economy to slow to 4.5% next year. Okay, with regards to the tariffs, let's say by the US and maybe later by the EU, I think for the tariffs it's been selected. And I think the other important point is that in the previous, let's say, 2018 to 2020 episode, okay, that was a surprise, so, and that came on the back of the Fed also stepping up its rate hike cycle. So I think today, situation is a bit different. We've also gone through a lot of lack of confidence with regards to China and the renminbi, so, but nonetheless, we do think that when the Fed cuts come, when it starts bringing the dollar lower, especially against the Asian currencies, that will also provide some respite for the renminbi. Okay, so for the Hong Kong dollar peg, my colleague Zhang Weiliang, he noted that ever since the Fed's final hike in July, dollar Hong Kong did not hit the ceiling of its convertibility band. So I was telling him that's pretty a nice observation. The other thing is that there's no stress as evident from the 1 month HIBOR staying below the 1 month LIBOR. So I think for us, we are still very focused on the Fed cut. And if you look at the chart here, in the last two rate cut cycle, the dollar Hong Kong should return into the lower half of its convertibility band. Okay, so India just had its elections. I want to highlight that India, to me, is a remarkably stable currency, despite dollar India hitting new highs. As you can see on the right-hand side, I've indexed, let's say, the performance of the Indian rupee, since the start of 2022, just before the Fed hike cycle started, against the emerging Asian currency indices and the DXY index. So India, initially when the jumbo hikes came and really pushed the dollar strong in the second half of 2022, it followed the Asian index lower. But ever since the dollar started consolidating, against both Asia and the developed markets, you find that it has been choosing, to stay in a stable range. But going forward, after the election, notwithstanding, I think some disappointment in the market with regards, to the outcome, we are focused very much on the next phase of India's development, where India aspires to be a $5 trillion economy by 2030. The IMF has just come out, to say that they think India can overtake Japan's economy next year, 1 year ahead of what they originally thought. RBI has also set up a department, to look at developing India as a financial center, and eventually making the rupee a more internationalized currency, and maybe even getting the rupee to be part of the IMF SDR. But in the immediate future, we are now in June, and Indian bonds are starting to get into the global bond indices. So we are going to see, I think, a very exciting period where India will be looking to become a more prominent world economy, and supported by its financial market developments, also reflected in its aspirations for the currency. So what I'm trying to say is that if you look at this chart, let's say the Asian currencies, and the dollar indices, they have been fluctuating, and we're now sort of at the lows, and we're near where dollar India is. So, so when Asian currencies, I think, going forward, when they recover, I'm beginning to think that maybe it is time for India to not resist the next leg of appreciation. Okay, so coming to Indonesia. Indonesia has also been viewed as one of the currencies that's struggling to keep its currency stable, especially at the 16,000 level. Yesterday, the BI came out with their targets for dollar IDR. So the average that they expect dollar IDR to be in is 15,700 to 16,001 for this year. Okay, this is very interesting because, I've been tracking, dollar India as on an index basis, since 2023, between, again, the two EM Asian Currency Index and the DXY Index. So, most of us have forgotten, that when 2023 started, India was really the star in the region. As you can see here, dollar India was dropping much faster than, the other currencies. So I would say that this year is more of a catch-up, and so it has been more or less been aligned with the DXY until recently. It's been kept, at the level where the emerging Asian currencies are. That's where you see in Indonesia, adopting rate hike or interventions, to cap dollar India at that level. Okay, so but what I'm trying to say is that, if you look at this index, it's, the levels as marked by these two Asian and DXY is similar to what, BI has just come out with its currency target for this year. Okay, so, this is the last slide before we go into Q&A. Okay, so of course we must finish with the Sing dollar as a price taker. Okay, before I end, I'm going to give you another fun fact. So today is 5th of June. Okay, so in 1959, this is when Singapore became an independent state, after Malaysia kicked us out. So, so in any case, Singapore dollar is a price taker. Okay, how do I know that? Just look at the chart on the right. This is dollar Sing mapped against the dollar index. So this is a very high 90% correlation. So in short, if we are correct about the dollar index coming off on the Fed's 50 basis cut in the second half, then we will expect dollar Sing, to go down lower as well. So if the index, let's say, goes down to 101, then dollar Sing should move back down to about 132 to 133. Okay, so before I bring timer in, one last thing. Okay, and that is that MAS will be meeting next month. Han Teng and I have decided to keep our call for them to slightly ease the slope of the Sing. Han Teng believes that, the import prices are negative, so that should give it room. I have noticed that my own Sing model on a year-on-year basis has dropped, the appreciation has dropped to about 1.5 to 2.5%. And that's the inflation forecast that MAS has for this year, minus the GST impact. Okay.
All right. Philip, so that's a big call. So we're basically saying that there will be monetary easing done by the MAS long before the Fed is in a position to ease monetary policy. You heard it here first. It's a big call. And related to that call, you may have noticed earlier that we were talking about the long end of the Sing dollar curve having room for a rally. I think the two calls are sort of complementary to each other. Let's go to Pigeonhole. The first question is actually for Philip. And even before it goes on the screen, let me just read it out to you. Philip, ECB. Despite a rate cut by ECB, dollar should still benefit from favorable growth differential. Would that be dollar positive?
I take the view that it will not be dollar positive. I think the ECB, as I mentioned earlier, is going to be managing expectations. so pushing back the market in expecting a series of rate cuts after tomorrow's cut that they pre-committed earlier in the year. So I think the language and the market, I think, is sort of queuing in. If you look at the OIs and the futures, what's interesting is that the market is looking for ECB and the Fed to cut in September and in December. So pretty much in lockstep. So given this, I think you'll still be, I think, in the range. But my bias, really comes from the economic growth front, which I think for the US, we are coming from the top. And I think for the EU, we're coming out of the technical recession.
Right. Yeah. Philip, on the rate differential side, even a different scenario would still sort of be consistent with your bias, which is, let's say the ECB cuts once, but they really can't cut anymore, whereas the Fed doesn't get a chance to cut at all. So then we're also talking about no relative widening of the differential in a meaningful manner. So whether they both cut or they both cut very little, I think the outcome will be more or less the same. One more FX question for you, Philip. This is, will China use the yuan to push exports in the face of fresh US curve? I suppose the question is, will they allow for significant weakening of the RMB?
If you look at, let's say, the recent move in the fixing, it looks like, they're allowing the dollar China higher. But, if you step back and you look at the other chart that I've shown, I think that's the reason why I decided to put that chart. They're really keeping the currency stable. I think China really wants to renew confidence in the economy and is now more willing to do, much more than what compared to last year in terms of helping both the economy and the property sector.
Right. Okay. Very good. Maybe one non-FX question. I'll take that one, Philip. Okay. This is related to megatrends. What trend do you see emerging or extending for the rest of 2024 or maybe further ahead? I've been thinking about this issue, and I think that you cannot have a monetary policy cycle that inflicts virtually no pain and things just kind of work out. It doesn't happen like that. It hasn't happened in history. I don't think we're going to have an immaculate soft landing with very little collateral damage. And my call would be, in the second half of this year, the big theme would be that the system showing signs of stress under the weight of high interest rate. It will not be across the board. There's a lot of strong fundamental underpinning to the markets. I'm not calling for a huge crash in the market. I'm not calling for a huge recessionary outcome in the US, but I am calling for the marginal weakness to manifest both in financial markets and the real economy. I was in Hong Kong last week before I went to China. You can see the impact of high interest rate in the economy palpably everywhere. Property developers, corporations, anybody who is part of the leverage part of the cycle, they don't need that kind of high interest rates. But since their monetary policy is married to the US, they're feeling that pressure. I don't know how much longer that pressure can persist before we see some event risk there. Similarly, there are other parts of the US economy where there is leverage, particularly on the leveraged loan side of the commercial real estate market, perhaps also on private debt, areas where we probably expected pain to manifest in recent months and years. It hadn't, but that doesn't mean it will not. So that would be another area that I'll keep a very close eye. And the third area I will keep a close eye is Philip's area. I do think that the manifestation of global market uncertainty will be in the FX space. So this is a tail risk, not the baseline forecast that Philip prepares, but just in general, where will we see risk manifest? I do think the dollar could become volatile, and around that we could see volatility in the EM space, particularly if the Fed does not get a chance to cut rates. It would create additional pressure on EM. EM would struggle to allow their currencies to depreciate because they'll fear that a Trump presidency or a more protectionist US would lead to tariff if the currencies weaken so much. So I think that's where we can see stress, not just in the second half of the year, but spilling over into 2025. So yeah, currency, watch out. The low vols are not here to stay, in my view. I think it could manifest in significant pickup in volatility. And then, of course, on the real economic side and the financial market side, expect that to come up. So the lagged but substantial impact of this historic monetary policy tightening, I expect to see that to be the theme of the second half of 2024. Philip, thank you very much for being with me on this live stream. Thanks to our viewers as well and our excellent tech team here at DBS Asia Central in our strategy and marketing team. We will see you again next month. Until then, everybody, stay healthy, stay safe. Bye-bye.